The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy, Jason Hartman, the real estate expert extraordinaire, all the way from Florida. Jason,
hey, George,
welcome back to the show, buddy.
Good to be here. Good to be here.
Okay, so now you've really got your finger on the pulse of residential real estate. Our other good buddy, Kenny McElroy, well, he does residential, but it's more multifamily.
Right.
And so I really want to pick your brain and get your thoughts as to what the real estate market is doing right now with these single family residential homes. That's really where you do most of your research. That's really your business. It's been your business for decades.
Yep.
So let's start there, just kind of the overall market with these starter homes and contrasting linear markets, cyclical markets, and hybrid markets. And then I want to go into some inflation data so you can tell us how this inflation really pertains to today's real estate investor.
Yeah, absolutely, George. So we are in a situation with very constrained inventory still. I mean, that's been the story for a while now. But if people can just imagine it this way, our inventory levels right now of all single family homes in the entire country, whether it be linear markets, cyclical markets, or hybrid markets, low end, high end, middle priced homes, everything, just the overall marketplace. Look, picture this. You go into a grocery store and you look around and 2/3 of the shelves are completely empty.
It's like the Whole Foods I go to every day.
Oh, is it that bad? The Whole Foods near me is
not 2/3, but I'd say probably
okay.
15% of the shelves are barren.
Wow, really? Okay. And I used to go to that same Whole Foods because I know where you live, and I lived right near you before. And that's about what it's like. Our inventory levels of single family homes are about 1/3 of the normal amount. We have about 380,000 single family homes for sale.
Yeah.
And we typically have about 1.2 million plus. So inventory is 1/3 of what it should be.
So that's not even on a per capita basis. If it was per capita, assuming the population is increasing, it'd be a lot worse.
Yeah, you're absolutely right. But that isn't that old. When I'm going back to the 1.2 to 1.3 million, I'm going back like 7 years. Okay. So yes, there have been some population increases, but if you go back 20 years, you're looking at about 20 million people. So that's a big difference. And it's not just the number of people that's the issue. It's really the number of households. And so when you look at household formation data, that is largely dependent on the age curve. So what ages are these people? And right now, we used to all think of the millennials as young. Well, guess what? The oldest millennial's 41 years old now. So they're not so young anymore. The Gen Zers are the young ones now, and the millennials are moving right into, they're only 5 years away from their peak earning years and their peak spending years, the oldest millennials. So just think about how significant that is. In 2026, we will hit the leading edge of the largest demographic cohort in American history, 4 million larger than the baby boomers.
That was my next question. Yeah, just give
giant
it some
impact on the
context.
economy.
So bigger than the baby boomers.
Right. Yep.
Okay, so that's why we're seeing demand so high. I guess on the demand side of the equation, the first chart that comes to my mind is this chart I've been using that really breaks down M2 money supply.
Right.
And have you seen that one I'm referring to? Joseph Wang, who's my buddy that used to work at the Fed. He ran the New York trading desk. He introduced me to this chart, which is really breaking down M2 into its kind of detail and nuance. And this is a Fred chart of American households and how many dollars they have in their checking deposits.
Right.
In aggregate total.
But can you put it on the screen, George?
Yeah. Let me see if I've got it on my browser here. And okay.
Wow.
So,
the hockey stick.
Yeah, and I can't really move it because we're doing a screen share, but if you look at where my pointer is,
right,
this is the end of 2019, call it prior to the cerveza sickness, the amount of dollars that were on the balance sheet of households in aggregate total in the United States in their checking deposits, about 1.2 trillion. You take that to today, where we are over $3.6 trillion, an increase of 2.4 trillion at a starting point of 1.2.
It's tripled.
So that's a lot more money for down payments, isn't it? Combining that with the demographic variables that you were referring to earlier, and is it any surprise that demand pretty much at any price for these starter homes has just gone up and up and up and up? So I guess my question would be, is the lack of supply due to just builders not building, or is it a result of just increased demand due to these factors of demographics and we'll call it money printing?
It's both for sure. When we have these enormously low interest rates and we've had 10 years of investors just buying up the market, the investor part of the market is such a big portion now, George, which has not happened historically ever in the US, that these investors are buying and holding rental properties as we recommend they do, and I'm doing it, and you are too, and that is keeping inventory from home buyers, right? Because it's never selling, right? They're just keeping it and renting it always. And then of course there's the institutional players that are about 5% of the investor market now, but growing still. And then of course you have 10 years of home builders basically not building entry-level homes. And so all of these factors converging to just see a very, very tight market. And that chart you just showed of M2 is shocking.
Household, it breaks down M2 by a little more detail. But let's kind of unpack that a little bit further. First and foremost, let's explain why. You talked about all these investors piling into the market, where let's just throw out some numbers just so people can understand the concept. Usually, let's say 95% of the transactions in the housing market are between sellers and owner occupants.
Right.
Now, let's say that number is 50-50, where it's 50% owner occupants, 50% investors, which a lot of those investors are these huge pools of money, private equity, etc. So why do we see so many investors now gravitating towards real estate? And where I'm going with that is the Fed. When the Fed keeps interest rates artificially low and the quote unquote risk-free return on the 10-year is 1.5%, and these pension funds, as an example, which would correlate to the private equity, because that's a lot of the pool of the money that private equity manages is coming from those pension funds. They're trying to get at least a 6 or 7% return in order to meet their obligations. So if you can't do that with a 10-year Treasury, it forces them to go further and further and further out the risk curve and try to find yield anywhere. And I think that's, correct me if I'm wrong, but that's probably why they've moved into these single-family homes.
You're absolutely right. Now, I don't view the single-family homes as very risky, but I know what you're getting at. You can't just put it in a Treasury or a CD, and it's forcing older people to do the exact same things that these pension plans are doing. And it's dysfunctional. It's just a completely dysfunctional environment that the Fed is creating. And the rebel capitalists listening just need to get on the right side of that trade. Most of them already are, but maybe some haven't taken action yet. And hopefully they'll see us in Houston and they'll be inspired by your show. But yeah. You're absolutely right.
Yeah, well, and we'll plug that real quick. Both my good buddies Jason Hartman and Kenny McElroy will be in Houston speaking at Rebel Capitalists Live. That's January 7th to the 9th. So if you haven't got your tickets, make sure you do so. It's rebelcapitalistlive.com. Going back,
and can I just add to your plug? If I may? This is not a commercial; it's an infomercial. your first Rebel Capitalist Live in Miami was fantastic, George. I got to tell you, just the networking, the just really great conversations with such intelligent people in your community. Super impressive. It was great to see a lot of the people in person that are always commenting on your YouTube videos.
Yeah,
you know,
yeah. You know what's funny about that is a lot of people that came up and introduced themselves to me. They didn't say, "Hey, my name is Jason." They said, "Hey, my name is whatever their
handle was."
Yeah. Like, oh, open-minded investor or something like that. I'm like, oh, I recognize, because if they say their name, I wouldn't recognize them.
I know, it's funny.
Okay, so now let's go back to kind of unpacking what you're saying about the shortage and supply with the builders, not just, or with the builders not building any more of these starter homes. So when we're defining a starter home, let's just say 3-bed, 2-bath, 1,500, 1,200 square feet, just in a good neighborhood. It's what people, when they're starting the households, they'll want to buy, or when people are kind of moving down the economic totem pole, that's what they're looking for. Are these builders just greedy, or do they just hate poor people? You know what I mean? Do they hate? Because this is what you hear in the media.
Right.
You and I both know this is utter nonsense. But let's explain why they're not creating more supply, and then what that has to do with the rates of inflation, and then take that back to the Fed.
Yeah. You know, largely left-wing governmental policies are making it impossible for builders to make any margin, any profit, and make low-priced homes economically viable. For example, if you look at Northern California and you're a developer and you want to build a house in Northern California, before you dig that foundation, before you do anything, you're going to spend $170,000 on permits, impact reports, everything, right? Before you do anything. Contrast that with a more business-friendly market in, now I'm not being specific here, but states like Tennessee, Florida, all the usual suspects. You're going to spend about $6,000.
Wow.
So if the left-wing government in the Socialist Republic of California, which by the way is my home state, I lived there most of my life, now I live in Florida, but if they wanted to help people, they would loosen the restrictions. They would make the zoning more friendly, and they would allow builders to build more homes. You know, George, I'm sure you've heard this old kind of riddle, right? You know, what do you call a developer? Someone who wants to build a house at the beach or in the woods. What do you call an environmentalist? Someone who already owns a house at the beach or in the woods. Okay.
That's good.
They've already got theirs. Keep everybody else out, Yeah,
that's so true. And they just want to see the equity that they have in their house, or the nominal price go up and up and up. And that's really what they care about.
No, and past beyond the zoning, which is, it's sort of more at the macro level of the city, right? And the urban planning aspect. Then you look at the house itself and all of these new requirements that just throughout my career, I've seen them progressively become more and more onerous. First of all, the paperwork to buy a house, when I started in the business as a traditional realtor, first year of college, 19 years old, it took 1 page to sell a house. That was the offer form. It was 1 page long, one legal page, 11 by, 8.5 by 14. Now it's a stack of papers with tons of additional requirements on the seller and disclosures and all of this stuff. And, they've made it so everyone building a house, they've got to install low flow everything. They've got to install, windows that don't let the rays in to heat the house up, and better insulation and all this stuff. And listen, and more smoke detectors, more carbon monoxide detectors. I get it. All of this stuff is safe and it makes lives better. I understand that. But it also puts people out on the street and makes them homeless. Right. How safe is it to live on the street when people can't afford a home because they've increased the regulatory burden so enormously that you can't build a starter home anymore. Your home has got to be, $400,000 to $700,000 or more to make that an economically viable project. And that's in an inexpensive land market. You put that in a market where the land is expensive, the price doubles or triples easily.
Yeah, that's right. So even in a market like, I think you said Nashville, Tennessee,
Right.
To have that, to build that, let's just say the going price per square foot is
$150.
$150. Okay.
Yeah, to build it.
Yeah. Well, the price per square foot to sell it's going to be 150. The price per square foot to build, let's say that's 200.
Mm-hmm.
And therefore you're not going to find any builders that are willing to build that 3-bedroom, 2-bath, 1,500 square foot house and take a $20,000 or $30,000 loss every single time they build a house and try to make it up in volume.
Yeah,
that's
exactly.
only something the government can get away with. The private
Right.
sector can get away with it.
Yes. That's funny. Only the government can get away with a lopsided business plan like that. Yes.
Yeah. So this really starts to make a lot of sense when you consider these variables we've talked about with the and I hate to use the term money printing, but the creation of dollars, excess dollars, additional dollars on the balance sheet of the average American household, and then the demographics, and then the lack of supply. So how does this, I mean, at what point where do prices have to go, let's just say, in these linear markets in order for it to make economic sense for these builders to start to build again?
Well, the median price home in America is about $380,000, give or take, and depending on which survey you're looking at, but let's call it 380,
what
right?
What size is that, Jason? Is that around 2,000 square feet?
Yeah, it's approximately. Of course, it depends where, and it depends if it's attached or detached, and so on and so forth. But yeah, we'll call it a 2,000 square foot house. But the thing they don't tell you in those square footage surveys is density, right? You know, in the old days, like the post World War II, and I know you want to talk about the 40s, which I can't wait to get to that. The baby boomers were building smaller houses, but they were on a half-acre lot in Lakewood, California, right, and near Long Beach, where I used to live in Southern California. And so, yes, you got a smaller house. And so if you look at the statistics, everybody will say, well, Americans are living so much better because look at, they have double the square footage they used to have. Well, right, that's not inaccurate, but they're crammed on top of each other like, rats in a cage. I mean, they're living 18 units per acre. Yeah, they figured out how to cram that square footage in there, but they have no yard, right?
Yeah, that's a great point. All those properties that I bought in Kansas City when I retired, they were built between the 60s, 70s, 80s, stuff like that. But especially the ones in the 60s and the 70s, they're about 1,000, 1,100, maybe 1,200 square foot. But just the fence, I remember, on each side was probably, I mean, you had a good
20, 30 feet.
20 feet, between the fence and the actual property. And then behind the house, my goodness, you had a huge backyard. And this was in pretty much every house that that fell into that category. But now you go into like a Portland, Oregon, or you go into some places here in Phoenix, and that the edge of your house is the fence.
Yeah, that's called a zero lot line. Yes.
Yeah. So I've definitely noticed that myself.
Yeah, no question about it. So, you talk a lot about, and you've taught your listeners and viewers a lot about things like inflation, of course, but also shrinkflation, or skimpflation. That's the new one, right? We've been talking about that lately, and we're just getting less and less as we're paying more and more. And it's not always apparent, because think about all the stuff nowadays that we are constantly frustrated with in our everyday life. And we're frustrated because we no longer have anybody helping us do it. We're doing everything ourselves.
Yeah.
We're buying our own airline tickets. We're pumping our own gas. You go to a nice restaurant. Some of the really cool, trendy restaurants in your area in Scottsdale, George, are, you go up to the counter and you place your order. They give you a number, you put it on your table. They might bring the food to you, but they don't bust the table. They're not giving you a waiter. You don't really have a waiter service, but you're still expected to leave the same tip.
Yeah.
That's shrinkflation, right? It's not the same level of service.
Yeah, and I compare apples to apples because I lived in Scottsdale or in the same area I live now back in 2007, 8. And I remember back then, just anecdotal story, pretty much every nice restaurant you went to had valet. Every single one, without exception. And now it's maybe 20%, something like that. And you know what I was thinking the other day? I went into a grocery store and I was leaving, and I bought a box of water, like 12, like a case,
Right.
12 of these bottles, and it was, I mean, it was pretty darn heavy. I work out almost every day, but
no one's helping you. Yeah.
yeah, and it just dawned on me out of the blue. I'm like, you know what? I remember when I was a kid, my mom would never, ever walk the groceries out to the car. There was always a kid there that was designated to carry your groceries out to your car and load them in the trunk for you. And now you just never see that.
Service is over. And, going back to the gas station example, it wasn't just that they would pump your gas for you. They would check the oil, check the washer fluid, check your tire pressure. I mean, imagine that nowadays. You have to pay for air to pump your tires up.
Yeah.
It's $1.50 for air.
Yeah. And now what I've noticed is the air pumps around my local area, they don't even work because they've broken down and they can't get the parts to replace them.
Yeah.
And now every single air pump, not only is it $1.50, but that's if it worked. There's just a big sign on it saying out of order.
Exactly. And the interesting thing is none of the stuff we've just discussed, George, is in the consumer price index.
Yeah, that's right.
Yeah.
Yeah. So they have hedonics in there, no problem. But then when it comes to these other things that definitely affect the quality of life, they're completely omitted from the equation. But let's go into inflation. I'm really thinking this through for a whiteboard video, and I'd love to hear your thoughts on the difference between the inflation we experienced in the 1940s, which no one really ever talks about. And I find that odd because the levels of inflation that we saw during periods was higher than what we saw in the 1970s.
Yeah.
It was just kind of more consistent in the 1970s. But I like to try to think about why we had the inflation in the 40s and then why we had it in the 70s, because it was much different. And then look at the environment we have today in the 2020s and ask ourselves the question, is the 2020s going to be more like the 1940s from a standpoint of probabilities or more like the 1970s? And I think this really pertains to not only real estate investors, but probably a lot of owner occupants out there because they have a 30-year fixed rate mortgage.
Right.
Obviously, inflation is what you want because you want to pay that back with cheaper dollars.
Yep.
So let's go into a screen share. Okay, can you see that?
Yeah, this is from Alhambra, from Jeff Snider's group,
Snider,
right? Yeah.
Okay, so what we've got here, Jason, and you just pegged it. This is from our good friend Jeff Snider. And this is Treasury market inflation component. This is from his blog, but he goes back to 1943, and the shaded gray area is the level of inflation, and he takes it up to 8%. I know this one right here that my pointer is over, that got up to almost 19%.
Wow.
Believe it or not, right there in 1947, 48, extremely high. But then you'll notice this time frame between 49 and 50, we actually had deflation, not disinflation, but prices were going down by about, I think, -2, -3% per year. And then 1951, we have a huge supply shock again because of the Korean War. So what Jeff is doing here is he's pointing out the fact that according to his definition, what we saw in the 1940s really was not inflation because it wasn't an increase, a substantial increase or a consistent increase in the overall money supply created by the commercial banks. It was really due to these, or mostly due to these supply shocks we saw during World War II, post-war supply shock, and then going into the Korean War. But he said all that changed in about 1957 when yields really started to go up on the 10-year and start going up consistently, where we had higher highs and higher lows. And then that's when we really had the commercial banking system printing more and more and more money, which brings us into an environment where we have more secular inflation. So here we had these spurts of inflation in the 1940s, where starting in the 1950s into the 1970s, we had more persistent rates of inflation that gradually increased in size. So what are your thoughts so far? And then I'll go into kind of some takeaways with what we're seeing right now in the 2020s.
Well, I mean, it's hard for me to tell. You've studied the 40s a lot more than I have. I really study the 70s a lot. So I know quite a bit about what happened in the 70s. But there's so much disruption and distortion in the market due to the war, right? I mean, that was just obviously a massive global change, and then the Marshall Plan coming out of it.
But same
And
thing we've had with COVID as far as supply shocks. I mean, not due to a war, but it's still
yeah,
the same type of supply shocks.
yeah, well, it's a war of ideas and a war for our freedom and our bodies. I'll tell you that.
That's true.
That's definitely it's a different kind of war. But
Yeah.
yes, you're right.
Let's actually let me pull up another chart that I got from another good friend of ours, Lynn Alden.
Mhm.
And let's try to think through the 1940s from a standpoint of if you would have had a 30-year fixed rate mortgage back during a time in which technically, if we're using the proper definition of inflation or the Milton Friedman definition of inflation, where it's always and everywhere a monetary phenomenon, we didn't really see this secular inflation due to these supply shocks. These are the charts from Lynn, where she points out first the inflation spikes we saw during the 1940s.
Yeah.
And then here's those bouts of actual deflation, which I don't think we'll see today. But then she points out that it is true that this might not have been a monetary inflation the way Milton Friedman would define it, and they might have been temporary spikes, but each time it goes up, it's not like prices go back down to where they were in 1940. They go up to a high water mark, and they go up to a higher high water mark, and then an even higher high water mark here in 1952. So it's kind of this stair step approach.
Right.
So if you would have had a 30-year fixed rate mortgage in 1940, let's say on a rental property, what would rents have done by 1952?
Well, rents should have followed inflation. Now, keep in mind, I mean, back then, although I know this is a sort of hypothetical question, there wasn't much of an investor market at all. I mean, I doubt hardly anybody bought homes and rented them out. That really started with a guy named William Nickerson in the 50s, where he wrote some books about it and became quite famous for his day. He was like the world's first real estate guru, I think.
I didn't realize that.
Yeah. There just wasn't much of this activity back then. I mean, a little bit of it happened, of course, but rents should have hedged inflation nicely. If we can
right here, Lynn points out that consumer prices increased 90% from 1940
in 12 years.
To 1952 to a permanent higher plateau. So I can almost promise you that rents would have gone up by probably the same number.
I agree with you. I just wonder, it's sort of hard to interpret the 40s, I think, because think about it. There was almost no trade. America was the only industrialized country after everything was destroyed in the war, right? And until we rebuilt Japan and Europe, I mean, we were it.
Yeah, that's
and
right.
the 50s was really a very optimistic time, other than the fallout shelters and the threat of nuclear war, which weighed heavy on people. It was a great time in America, really a time of prosperity, and all these, the automobile really took hold, and the American car companies they had no competition, so they were the big deal, right? So it's just so different than it is today.
That's a great point, because if the viewer is not following that, what Jason is saying is that now we have this global economy, so we can offshore a lot of that inflation, because in the 1940s to the 1950s, from 40 to 52, pretty much everything that not everything, I shouldn't say that, a large percentage of what we consumed would have been made right here in the United States.
Yep.
Therefore, if prices are going up, if wages are going up, then that's going to have this spiraling effect, this positive feedback loop going higher and higher, higher. But now
it also meant that American workers had high-paying factory jobs too, which they don't have now, obviously.
Yeah, and because there's the option to take all of those goods that are being created and offshore them to places like China and Taiwan and all these other countries offshore or outside of the United States to bring in those cheaper prices. So that is very true. It'd be interesting to try to think through what would have happened to consumer price inflation in the 1940s or during this 12-year period if they would have been able to offshore a lot of that manufacturing to cheaper countries. I think we still would have seen significant price inflation, but it probably would have been 90% to your point.
Yeah, it's interesting. And George, I want to ask you something actually. I remember when we had our collective mastermind meeting there in Scottsdale just 3 weeks ago. By the way, fantastic event. It was just so much fun. Rarely am I part of doing the event, and I'm having a good time, but I was having a great time, and so were you. It's just such a great group of people we've got in the mastermind group. So
yeah, it sure is. It sure is. And we'll be coming out with photos and videos of what we did. So what's our website? I don't even... thecollectivemastermind.com. Okay, yeah. So check out the website here in the next few weeks, and you can see video footage and photos from that weekend that Jason's talking about.
Yeah, and we've got our next one coming up in Florida in early February. So if you're not a member of the Collective Mastermind yet, apply, because we'd love to check out your application and talk to you if you really want to create an investment portfolio that really, really works. You've got the benefit of George's macro advice, of my single-family home advice, and of Ken McElroy's multifamily home advice. His syndication. A lot of people want to become syndicators and do things like that. So we've just got such a great group of people. But the thing I wanted to ask you was about the comment I made from the stage, and maybe I'm giving him too much credit. But Richard Nixon, of course, he killed the gold standard issue in 1971 on August 15th. And then his historic trip to China, which was just amazing to people back then. It was a surprise. And, I'm wondering if he knew the inflation that was about to come with LBJ, his predecessor's Great Society initiatives, and the welfare state growing. And that's why he went to China, because China in 1978, George, as you know, really opened up, and it became the workshop of the world. Think about what would have happened if China never happened and we were just importing stuff from Europe and making stuff here. Inflation would have been rampant in the US the last several decades.
That's a great point. Yeah, and you combine that with if we would not have had the petrodollar.
Right. Yeah. And immigration from Mexico. Also, to bring in the cheap labor. We got the cheap goods from China and the cheap labor from Mexico. Right? So, yeah. Very interesting topic. And I think the main takeaway here for people is this inflation thing is complex. It's not just cut and dry. Oh, the government's printing money or the Fed's printing money, right, therefore we're going to have inflation. Maybe not. There's a lot of different components that you need to consider. And also, in considering those components, it'll give you a better handle on what we will most likely see here in the 2020s. And that's, are we going to see inflation where we have these big spikes like the 1940s, or where we have something like the 1970s where inflation is more persistent and it's kind of this gradual climb up, although from year to year it's kind of going up and down. And then you combine that with, well, now we've got globalization to the tune of our trade deficit going from 40 billion a month to 80 billion a month. But then what makes it even more interesting is now that they have all these lockdowns, and now if you do have a big recession in China, then because of what's happening with Evergrande and their real estate market, that means that they will produce less stuff. Therefore, they're going to consume a greater percentage of the stuff they're producing. Right.
Therefore, they could have less stuff to export to the United States, where we're not going to make it here. We've got to go somewhere else. And most likely, if we do go somewhere else, even if it's offshore, it's going to be at a higher price. And then now we're importing the inflation that we have been exporting since the 1970s. Yeah. So another variable. Do you have any thoughts on that?
Yeah, I agree with you that it's another variable. The last bastion of cheap labor is Africa, and Africa is very messy and very fragmented. And that's, China is all over Africa. They're trying to also exploit the opportunities there. And, that's it. I mean, we've run out of cheap labor after that. Okay, and
Yeah,
we
that's
may
a good
have
point.
really run out of it already. So it's dependent on technology and automation to continue to make cheap goods. Uh, and I just think there's a lot of inflationary pressures with all of these different factors.
Yeah, I
It's
think my base case is we go through a 1940s, but the peaks in inflation are lower, and
Mhm.
but we don't have the actual deflation. So, as an example, let's just say that we're living through this spike right now that we saw in 1943, but today it's a 2021 version of this because of a supply shock. I think it's saying that the CPI went up to 8%. I think, yeah, maybe we go up to 8% here in 2021 or in 2022, but then 2023, maybe we go back down to maybe 4%. I don't think we'll go all the way down to zero or below zero. I think we'll always have inflation for a variety of reasons. But then, in maybe the 2025 or 2026, then we have a big spike up to maybe not 19%, but maybe it's 12%, 13%, 14%. And then we have something that crashes back down, but to a level higher than zero. And this is assuming that we still have the system of creating dollars we have today, where the commercial banks are largely responsible for that if the government isn't deficit spending that's being monetized by the Fed. If we have a central bank digital currency, then I think we're off to the races here with the 1970s.
Yeah. Well, if we have a Fed coin, that changes everything. I mean, that's game over. That's
Yeah.
and if they make it so it's coordinated with other governments and central banks, and there's like no place to go, because that's what Janet Yellen is behind, this corporate minimum tax, and now a bunch of
Yeah, good
countries are
point.
agreeing to that.
Good point.
They're trying to make it so there's no place to run, right? They're already controlling travel like crazy, and I've always said that. I mean, I was saying this back in 2003, 2004. The day there is a global fiat currency, it's checkmate. That's just like game over for humanity. They can do whatever they want. Now, that was before crypto. I didn't even know that was coming, right? But so, yeah, it's who knows? But
Yeah.
I mean, overall, the future does look pretty inflationary to me.
Yeah, I think that's where I was going with it. Let's try to look at it through the lens of of a real estate investor or an owner occupant with a 30-year fixed rate mortgage. And the takeaway here is, regardless of whether we go through a 1940s type scenario or we go into a 1970s type of scenario, you're going to be paying that thing back with cheaper dollars. That's for sure.
That mortgage, yeah.
Yeah, that's right. Yeah, that's what
Yeah.
I'm referring to.
Yeah.
So now, how do you juxtapose that with the fact that the real estate market is at all-time highs? I would argue that it's definitely in a bubble. How do you kind of process that in your own head with your own investments?
Well, it feels like a bubble, but how far can the bubble? Maybe the bubble's only 1/4 of its ultimate size. Yeah, I agree. Everything seems bubbly, like there's an everything bubble. All assets seem that way. But I remember quoting an article many times back about 16 years ago by Michael Milken and Jeremy Siegel. And Jeremy Siegel made a really interesting comment, and it was about the rising middle class. And at the time, about 275 million people had been lifted out of poverty around the world because of globalization. That number today is maybe 400 million or more. I don't know the number, but it's higher. And he was talking about resources, but he was also talking about assets for investment. And he said, where are all the assets for these people to buy? As people come into the middle class, they become investors. They enter the investor class. And he basically was predicting a huge asset shortage. And George, I'll tell you something, it sure feels like that. And now we've added a whole new category of assets to the marketplace of assets, and that is cryptocurrencies and NFTs. And even still, the money is just sloshing and chasing everything. I can tell you that I've made about 11 offers on houses in the past few weeks. I've gotten beat out on all of them. I was able to get 2. Every deal was, and this is for houses, multiple offers, higher than list price. The 2 that I ended up buying, George, I felt relieved that the seller let me buy them at full price.
What states?
Arizona and Florida.
Yeah.
Yeah.
Going back to what you're saying, and that's some really incredible insight about there not being enough assets for the population growth,
Yeah.
or at least the growth in the
middle class
dollars
population.
on the balance sheet of the middle class.
The middle class around the world, and then the M2 chart you showed earlier in this interview, it just shows you that like there's just too much dollars, too many currency units chasing the limited supply of assets. But the interesting thing with the crypto comment and the NFT comment is we've created new digital assets out of thin air. Talk about fiat, right?
Yeah.
And those are going through the roof too.
Yeah, but also the higher rates of inflation will exacerbate what you're talking about, because it is true that you have more and more people with more, let's say, disposable income to invest, and that could be globally. But at the same time, if you increase the rate of inflation, that will prompt the people that would not have invested into investing, because they know subconsciously that they're losing purchasing power by keeping that those dollars just locked there in cash. They've got to do something with it, or else that 100,000 they have this year is not going to have the same purchasing power in 1 year, 5 years, 10 years. So not only do you have fewer assets, more people, more dollars, but then you have people that are more incentivized to go out there and invest the dollars they do have.
Yep. You're absolutely right. They've got to go further out the risk curve. And I mean, do you think 70-year-olds should be buying cryptocurrencies and speculating on stuff like that? No, they should be allowed to put their money in laddered CD instruments and bonds and kick back and enjoy their retirement years without stressing about their investments. But that's not the environment the Fed has created. They've created an environment.
Or pension funds having to go into private equity.
Yeah, exactly. I mean, what are pension funds doing in all these risky investments? They should be, they've got to. The Fed has forced them to. They can't make a return otherwise.
Yeah, I did a story yesterday on a pension fund in California that was bragging because they were being so conservative with the amount of liquidity they held in cash in their portfolio, and that was 1%.
Was that CalPERS by chance? The teachers' retirement fund?
That one was not CalPERS, but for an industry standard for government pension funds, as far as cash on their balance sheet, is 0.8%. That's the amount of liquidity we're dealing with. So this guy was at 1%, and he was bragging about how conservative he was.
Wow, that's boy. If things go the other direction, there's going to be some tough problems. For sure.
But don't you think that they will bail out those pension funds, and that means more dollars that
means more inflation? Yeah.
All right.
I do think that. I do think they'll bail them out. Yep.
Yeah. Well, the bottom line here is, if you got a mortgage, make sure it's fixed rate. That's the simple takeaway of the whole video.
A long-term fixed rate mortgage. George, do you want to tell that funny story you told me in the Uber that night about the the relationship guy talking about mortgages?
I was listening to a dating guy, something like that. Somebody dating gurus. I don't know if I saw it on Instagram or something that caught my eye. And he was talking to this gal that he had got on a few dates with, and she was trying to have that serious conversation with him, saying that he's looking for something very secure and long-term. And he says, all right, sweetheart, well, what you need to do is get yourself a 30-year fixed rate mortgage.
Every time I think of that story, I still laugh at it. It's so funny. Yeah.
All right. And on that note, on our comedy bit right there, great conversation, my friend, as always. For my viewers and listeners who want to find out more about what you do, where can they go?
Yeah. My website is jasonhartman.com, JASONHARTMAN.com. And then also I have a free book for your listeners, George, at pandemicinvesting.com, where I sort of adapted the strategies I've been using for a long time for the crazy times in which we live. And it's a free book. It's an instant download. So just real easy, pandemicinvesting.com.
Awesome, man. I want to just remind everyone that you're going to be speaking at Rebel Capitalists Live in Houston, January 7th through the 9th. So make sure you go to rebelcapitalistlive.com and get your tickets. My good buddy, well, you're going to be here this weekend, aren't you?
Yeah, I will be there this weekend, but of course that's not an event. So that's just, I'll just see you and we'll hang out.
Well, it all depends on what we do. It could be an event.
Well, we're definitely going to have a couple of those stiff drinks.
We've got.
Yeah. Hey, I got to tell you, the funny thing is about George. I mean, there are many funny things about George, but he always says the stiff drink time thing, and that's become kind of a meme for your viewers. Yeah. But you always drink beer.
Yeah. And I never drink stiff drinks.
When you see George, folks, buy him a Stella. That's the one he seems to like.
Yeah. And on that bombshell, we'll leave it there. Enjoy the rest of your day, buddy.
All right. Happy investing.
Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist Live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, we'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.